I'm joined now by somebody who has more than 15 years' experience of working in the Treasury, the Department of Trade and Industry and the Central Statistics Office. It's Ruth Lea, Economic Advisor at Arbuthnot Banking Group. Thank you so much for joining us today. This has been heralded, the front page of the FT today, as the greatest economic experiment of a generation. Are you concerned that we're experimenting here with Britain's finances?
I think it's inevitable there's a bit of a gamble about this. By the way, I do think what George did yesterday was necessary. I've looked at the public sector borrowing figures for many years of my life. I was actually in the Treasury in the 1970s when we had the last crisis. And when you saw these figures, you knew it was not sustainable. And 18 months ago, when Alistair Darling had his 2009 budget, it was quite obvious the credit ratings agencies were flagging up concern about where our public finances were going. Standard & Poor's, I think, made it fairly clear if we didn't do more by way of fiscal consolidation, then you could actually see the AAA rating disappearing. So George had to do this. But, at a time when the recovery is still perhaps not as strong as it might be, it is something of a risk.
I mean, there is this issue about growth because, of course, we're going to see these public sector job cuts. Now, it's not going to be 500,000 public sector jobs that need to be absorbed into the private sector because people will retire in that time, etc. But even so, private sector companies, when I speak to their CEOs, they want to hold back money. They've got a war chest. They're not investing and they're not expanding. And how do you make them do that in order to employ more people?
Well, I think that's the problem. And in fact, it's been very interesting. We had a good growth in the second quarter of this year. Man, it was probably a bit erratically high. But it did seem then a lot of the surveys that were coming through in summer and in early autumn, they were going off the boil. And it was consumption, consumer confidence, it was investment intentions, it was everything, industrial surveys. They were all looking a bit weaker. And I wondered if it was them because they were getting a bit frightened, a bit cautious about all this rhetoric that was coming out of the government. And such a lot, of course, is to do with confidence. But I think going forward, the Bank of England has to have a very, very loose monetary policy. I guess there's going to be more QE. They'll hope there's going to be some continued growth internationally, and then they hope that that will push the growth into the economy.
Now, George Osborne has been speaking today. He keeps talking about the fact that there is no plan B. I mean, he can't say, obviously, at this stage that, well, I ought to hear my plan B right now. But on the other hand, there must be surely something up his sleeve. I mean, if we see a contraction in the economy, we can't just carry on with these cuts, can we?
I think the first thing is I think it's very unlikely there'll be a double dip because the private sector would have to do incredibly badly not to be able to actually fill the gap left by the cuts in total public spending, which are perhaps 1–1.5% per annum, which isn't so bad. But if for some reason it did happen there was a double dip, then he would have to do something, I suspect, tax cuts or whatever. More likely to do tax cuts than actually cut back on the cuts in public spending, if you know what I mean, actually relax the public spending. But I would have thought that if it's not a plan B, there must be some sort of spectre lurking away in the corridors.
Indeed.
Of the Treasury.
The relationship between the Bank of England now and George Osborne, obviously the Bank of England is supposed to be separate, but really there is there's an unwritten policy here that QE, or certainly inflation, certainly interest rates, have to stay low in order for this to work, right?
I don't think there's any doubt about that. And of course, Mervyn King would justify it. And he has to justify it by saying that he's going to hit his inflation target because that's his remit. And of course, inflation's running at 3%. It's ahead of the target. But somehow, we're not worrying about that too much because there's no wage price spiral. It's not as though earnings are taking off. If earnings were taking off, I think he'd have to put interest rates up. But they're not.
But, well, so we'll wait and see. If that happens, though, it's probably a good thing for the economy overall, right?
Indeed. I mean, I can't see that earnings inflation is really going to take off. I can't see that inflationary pressures are seriously picking up. I am one that is relatively relaxed about consumer prices, inflation being above the target. I think there are special factors there. And so I think what the bank is doing at the moment is basically right.
Ruth Lea, as ever, thank you very much indeed for joining us.